Welcome to PhillipCapital Expert Talk. My name is Sai Ting from Phillip Security Research. Today we are privileged to have Mr. Mangan, partner and portfolio manager of Harris Associates, to share with us his macro views on the US equity markets and investment strategy. A brief introduction of Michael. Michael joined Harris in 1997 and has over 24 years of investment experience. He previously worked at Stanroyd and Farnham, managing portfolios for institutions and individuals. Prior to that, he has also served as a senior auditor at Continental Bank. Michael is a certified public accountant and a CFA holder. Thank you, Michael, for taking the time to attend this interview with us. Let's start with the first question. The drop in August has resulted in a negative year-to-date performance for the US equity markets. Can you help walk us through what has happened this year and how has it affected the fund's performance?
In terms of what's happened this year, when we came into this year, we would have said the U.S. market was fairly valued. A fairly valued market, right around 15 or 16 times earnings, should provide, call it 6 to 10% return. Thinking of just the S&P 500, what should you expect? And that's what we expected coming into the year. When you got to the August and September period, first of all, you'd gone through June where Greece had become the biggest deal, around. Then you got to August, September, and it was China. And so everybody's very fearful about China. And what really happened is that I think people might be focused a little bit too much on August and September as the important aspects of what the market should trade at. Really, October, where we've seen a significant recovery, is just to get back to kind of a normal level where we're still at 15 or 16 times earnings. Expectations aren't that different. And really, to me, what happened in August and September was the anomaly. That was kind of the strange trading, the disconnected from fundamentals trading, 6 to 9% return expectations for the US market, and it doesn't look like that strange of an environment.
When talking about the US markets, it's inevitable the topic about the Fed rate hikes will rise. What's your view on that, and how do you think it will impact the US market? Further on, how would it affect the fund strategy?
First of all, we don't invest according to any macro themes. We really are, everything is company by company and very much bottom up. We've gone through a period of multiple years now of people waiting patiently for interest rates to rise. We're finally at a point where it seems that everyone is signaling that we're going to see a rate rise. It really doesn't matter if it happened this past September, October, December. It's very likely to happen sometime in the next 6 to 9 months. And for an equity investor, you should always be thinking about 5-year investing. So when you buy something, you want to own it and think that you want to plan to own it for 5 years. And so when you think that way, we're going to see a rate increase. It's going to be helpful to our exposure, which is we have some significant exposure to banks in the portfolio, or in our portfolios generally. And so we still, we believe that when that rate increase will be helpful to our exposures, and that it's coming.
How concerned are you with the bleak global economic outlook?
The market tends to focus, and investors focus a lot on macro events. It's a very, very difficult way to invest. So what happens when you try to invest in broad macro themes is that it's very difficult to make individual company judgments, and it's very easy to be wrong. And so what really changes very little is business values. So our company, Harris Associates, we focus on business values. And business values, while you see a market bouncing around, the underlying business values change very little. And really, it's not a matter of investing according to macro themes, but according to really direct business values. So overall, I would say we don't think the macro outlook is as bleak as the world seems to think it is, but it really isn't our direction in investing.
The MSCI USA Value Index has led the S&P 500 for about the past 10 years. As a disciplined value investor, what does this mean to you?
From our perspective, what we really want to focus on is absolute returns. So no part of our investment approach says, what is this benchmark doing? What is that benchmark doing? All of it is focused on don't lose money. Risk to us is if you put $1 into an investment and later you're going to have to sell that investment for less than $1, that's real risk. How you perform relative to a benchmark over a period of time obviously is important in the business, We believe if we focus on absolute returns and generating absolute returns, that over a long period of time we'll beat most benchmarks, and that's been our focus.
Finally, where do you see value in the equity market, and how investors can position themselves to take advantage of the market, especially for a fund in a large cap space like yours?
Well, value in the U.S. equity markets is in a couple places. One, you're seeing it in financials. So right now you can buy names like J.P. Morgan, Wells Fargo, Citigroup. You can buy those names for book value or less, selling for 9 or 10 times earnings, increasingly returning capital to shareholders in an environment where they're more regulated than they had been in the past, so you don't have the balance sheet concerns that you might have had. They're overcapitalized. So you have a pretty good backdrop for U.S. banks, and as we mentioned earlier, we start seeing rate increases, even though we don't model it in a significant way. When rates start to go up, it's going to be very helpful for these banks. They're going to get net interest margin that they haven't experienced in some years, and a growing net interest margin, which is a positive. We also see value in some of the commodity-related industrials. Obviously, you've seen the whole commodity complex kind of melt down over the last 12 or 14 months, and particularly in August and September. Names like Caterpillar, which is paying you 4.5% in dividend yield, has a fortress balance sheet, has a business that is really on kind of at we think the low point relative to what it could do over a 5-year period. So the demand for their products is lower than it's been in years. That will move around. There's a cycle to that. As it cycles, you'll see a lot better valuation of this company. In the meantime, you're making 4%. So the commodity-related industrials, Caterpillar, Cummins, look very attractive. And then aside from that, it really is more of a stock by stock. Earlier this year, the market decided that cable companies weren't very attractive. It really knocked down Comcast, which we own. It knocked down another company, Charter Communications, which is in the middle of has done this Time Warner cable transaction. And Charter Communications looks extremely valuable. You get the best management team in the business. You get John Malone on the board there. So you have a very attractive business proposition or business investment that is knocked down because of really just market action that we think is focused on short-termism.
Once again, thank you, Michael, for sharing your insights with us today. For more information on unit trusts, log on to our website at www.eunittrust.com.sg or talk to us at any Phillip Security branch. Thank you.